Hello guys, this is Market Makers. In this video, I will teach you all about liquidity in the market. There are two types of liquidity, internal and external liquidity. So firstly, we will look into external liquidity. So what is external liquidity? What is its use? Why market moves towards the liquidity area? Why your order blocks fail? And why market gives a fake out above trends and structures? I will explain you with the help of a diagram and then in the live chart. Why is a certain high or a low created in the market? You will have to understand why there is always a reversal after taking the previous high or a low. Market will always give a reversal after taking your previous high or previous low. Why will market form that kind of structure? You will have to understand. So let's start the video with external liquidity. Sometimes market will give you an order block over here and you will take the trades depending upon the order block, and market will give you hope, show you rejections from your entry zone and then break your entry zone towards your stop loss, and after hitting your stop loss market will tend to follow your directions. As you can see in this chart, the trend is bullish. So let me give you an insight. If the market is in a particular trend, either bearish or bullish, we will have to identify the order blocks of bearish zones in a bearish trend and bullish zones in a bullish trend. Yes, I agree you can take high risk to reward trades if you catch the trend reversals, but it will be more high probability if you trade with the trend. Similarly like that, market will give you an order block over here and you will again sell over here, but market will not respect the zone, go above, hit your stop loss and then fall, right? So basically, liquidity is the areas of your stop losses and the order book of institutions. Liquidity can be of any shape or size or any structures. You will have to identify which side liquidity is high probability depending upon the trend and the structure. External liquidity teaches us that there is liquidity above certain areas that are previous high and low, the major reversal points in the market. As you can see, market will behave something like this. This is the previous high. People will try to sell considering this high as a resistance, and their stop loss will be above here, and market will sweep all the liquidity, hit all the stop loss and then fall. Similarly, like over here too, the previous swing area, for this movement, this was the previous swing area for this movement. You will have to identify the correct trend to trade with precision. Generally what happens is, in this bearish structure, after market breaks its previous high, it will take a pullback. Generally in a bullish trend, market will break its structure upside, give a pullback and go upside again like this. So why these pullbacks happen? People might think that market is in a certain trend, that's why the pullback is happening, but every move market makes has some logic behind it. Why market always gives pullback after breaking its previous high or previous low? Let's understand it. So people will think this as a resistance zone and take their trades accordingly. So what will happen after that? So market will create liquidity above this area. All their stop losses will be now liquidity. So market will go as deep as their liquidity is. So if you trade something like this, put a stop loss above the previous high, so market will take a stop loss and then give your push to the downside. So after that, what happened, you can see it here, this is double bottom, or you can say equal lows in terms of smart money. Generally people will think this as a reversal zone and take their trades according to that. People don't know how to trade the equal lows or equal highs, theoretically called as double bottom and double tops. Market also takes its liquidity. So if you have ever traded equal lows and equal highs, you will have noticed market tends to sweep its top losses and then give your push to the upside. You can see there was a double bottom formed. Market will take its stop losses, all the liquidity below it, and then give the push to the upside. So when the market forms double bottoms or double tops, it will sweep its highs or lows by just wicks or a quick movement downside and upside. So sometimes it will just be a wick that sweeps the highs and lows while the body will close above or below previous zones, and sometimes it will be a quick reaction like this, and market will continue to move up from here like this. Similarly in this bearish trend too, it is double top formed. Market took the high, took the liquidity, hit the stop loss and then gave the movement. So the market moves where there is more stop losses. You have to keep in mind that you will only buy or sell when the liquidity areas are swept out. So if there is more stop loss over here below this swing low, then market will sweep this area then move up. So these things happen in market pretty often. You just have to figure out the liquidity points and buy or sell after it's swept. Same thing happens in supply and demand when people trade and market. There is nothing as such. The reality is everything is liquidity, and this will work in every market where there is manipulation. You just need to know how to use it well. And all the manipulation that happens in between these two swing points, for example, in these two swing points, every manipulation that happens here, this and all this is all internal liquidity, which we will see further. Let me show you a few examples in the chart, and then let's move to internal liquidity, which is more important. So guys, you can see here in this example, let me clear this. So you can see when this market broke its previous high over here, so you can see here there were buyers introduced over here because they thought the candle is closed above, and there were also sellers introduced. They were thinking it as a double top, so both are introduced over here. So those who were buying and whose stop loss were over here also got hit, and those who were selling over here got their stop losses hit because they probably set their stop losses above this area, and those who were buying thinking this as candle close, there's also a stop loss got hit over here. If not here, probably over here. The market gave them hope little bit over here with this move. Similarly, the act was same over here. You can see here this is considerably equal lows. Market took all the stop losses and then gave its push to the upside. So sometimes it will just be a little bit of wick, or sometimes a bigger move depending upon the ranges of the stop loss. The market will repeat its behavior over here too. Both the sellers and buyers both were introduced over here, so you can see volatility over here. So you can, this is a flip module. I will be posting a video on that soon. So all the sellers, their stop loss got hit obviously with this big move, but all the buyers, their stop loss also got hit over here. So if we had to enter considering this as a flip module, we would probably wait for the retrace of this order flow and then buy over here. So we would get a nice risk to reward from this to this with stop loss below here. So you can see volatility over here, both the sellers and the buyers. This is theoretically double top and considerably equal highs in SMC. So market gave a little bit of reaction and went up to hit all the stop losses, take the liquidity, and then gave a nice move downside, then continue the rally. You can see another example over here. There was something kind of a trend line going on over here. Also equal lows over here. People were trying to buy over here, considering this as a support. It swept all the stop losses and then went up. There is also liquidity formed over here with this move. With this move, people thought it's also buying opportunity because the candle was closed above. It hit all the stop losses with this move, and this move swept the previous lows and then continued pushing to the upside. Upside pullback. And why this move was such a big move? Because you can see over here, this was also consolidation move, so there were stop losses being gathered all over this place, right? So this could be kind of a trend line. Some people will mark this as something rectangular box and put the stop losses above this. So there is stop loss above here, and market swept all the stop losses and then give some pattern, right? Take the inducement, then fall. You can see over here too, this was liquidity formed. This were equal lows, and market swept the liquidity with just the wick and then continued its move to the upside. So generally in a trend, what happens is when market gives the break of structure, there are buyers introduced that will buy seeing this as a structure break. Then we also have sellers considering this as a resistance. So we have both the buyers and sellers, both are introduced. You can see first there were the stop loss got hit of the sellers and then of the buyers. So from where will the market move? Market will probably move after taking out the inducement or tapping to any order block, filling the imbalances, or tapping to your high probability POI. You can see there is an order block over here. So you will consider taking trades when market comes to your range. So it has a good imbalance too. So you can see order block over here. This is tapped, right? So market moves like this. So in this video we are just looking at the external liquidity that includes double top, double bottom, fake outs and breakouts, equal highs and lows, and all the channels and pattern that forms in the high time frame also come in the external liquidity. So you just understand that there is liquidity above any previous high or previous low. As you can see that the previous high is swept over here, and then this is the trend change. This is the main swing point and the market has fall down. You can see this was kind of a trend, liquidity all above below this, market swept all the liquidity. So this is a higher time frame, so everything that happens in between this is internal liquidity. So let's move on to that. So let's start with the internal liquidity, guys. I'll explain you about the 6 major patterns that you are used to in the market, and the first one is equal low or double bottom pattern. This is a reversal pattern, but before moving up or down, market will sweep the liquidity and then make its move. There are both the buyers and sellers introduced over here. There are stop losses over here and stop losses over here. So both are swept before making the move. So the second one is equal high or double top pattern, quite similar to the previous one. It is also a reversal pattern. As you can see here, there are stop losses, there is liquidity above this area and there is liquidity below this area. So market will sweep both the areas. And if you have to trade this, you will probably wait for rejections above this area, then enter your trade with some confirmation over here. Put your stop loss above the previous high that is made, and then your entry will be the next high probability demand zone. The third one is trend line liquidity. This can be internal and this can be external too. So what happens here is there are buyers introduced over here and over here too, and market sometimes sweeps the liquidity of just one side or sometimes the both, right? You should have seen very less times that market actually works with this pattern. So whenever this kind of patterns form, this it will be swept up before giving its move up or down. All the stop loss are below here, so market will tend to sweep all the stop losses and then give its move. Let's see the chart pattern 4. So this is a trend line or breakout liquidity. So what happens over here is after market gives this breakout, there are buyers introduced over here. With this move there are buyers, so they will put the stop loss below this or below this, and there are also sellers that are selling with this trend line which has stop loss above this area and above this area. So market will move where there are more stop losses. Sometimes it will just move till here, or sometimes it will go till here depending upon the amounts of stop losses. So the major thing is market moves where there is liquidity more, so it will sweep the stop losses up of the sellers first and then the stop losses of buyers, and then market will go in the opposite direction. So why this happens is because market creates liquidity, which is the main thing, and people don't talk about it, but the main thing is price attracts where the liquidity is more. So let's move on to the next one is flag pattern liquidity. So what happens is this is a kind of a trend continuation. So suppose there the market is bearish and it will form something, a consolidation range, and people will think it is a reversal or a trend continuation and enter without any confirmations. So there will be stop loss above this area, and there will also be stop loss below this area. So market will first sweep the stop loss above this area and then sweep the stop loss below this area and then move in the opposite direction, and then probably hit your POI, which can be an order block formed over here. Somewhere around here order block can be formed and market will tap the order block and then continue its move. So it works something like that. So I'm telling you this secrets. You should practice this in charts. Go to the charts, look through the charts and see this all works pretty well. You just have to see things differently to be profitable. Okay, so the last one is support and resistance liquidity. So it can just be support liquidity or just be resistance liquidity. Sometimes just thinking technically, there will be sellers in this trend line who put their stop loss over here, and there will be buyers who put their stop loss over here. So what do the market need? Market needs liquidity to move. So market will sweep the stop loss above and then sweep the stop loss below, then make its move where there are more stop losses. So think like that. You can take the screenshot of this to back test in your charts and to learn. So market needs liquidity to move. So market won't move unless it has your stop loss or liquidity. So the higher probability pattern you see, the more chances are of it being a trap. So you have to wait after market sweeps the liquidity to enter the trades, to be avoided from being the liquidity, and trade with the smart money, the banks and the institutions. It's not like it forms only in internal liquidity. This type of patterns forms in both internal and external liquidity. Okay, so I have an example of a bearish trend formed over here. So let me explain you. What happened here is, you can see market is taking its previous lows and giving a pullback. So what we saw in external liquidity is there is liquidity below its swing points, right? So what happens here is, the major thing what the smart money traders will mark over here is, suppose there is an order block over here, right? Let me leave it for a while. Suppose this is an order block and people entered here trades. The retail traders entered this looking as a breakout. Some entered this as a breakout over here, and who were selling in this trend line had their stop loss got hit by this move, and who were buying in this move got a fake out, right? And all the SMC traders who were buying in this order block got a little bit of reaction over here, and their stop loss too got hit, right? So you have to trade with the trend. You should not trade against the trade. Yeah, I agree, you will get high risk to reward, but what matters is your win rate too, right? So you will have to trade with the trend. So people got their stop loss hit over here, one liquidity, there were two liquidity over here, the stop loss below this stop loss, above this stop loss, and below this stop loss too. Those who were buying had a stop loss below this, right? So there was stop loss over here, right? So market took the major stop losses, the swing point over here, it took the stop loss and SMC stop loss too, and then gave a pullback, right? So market had the liquidity and now it's giving a pullback over here too. You can see people who were taking this in the consideration of a trend line got the stop loss hit. So there is liquidity number one, stop loss got hit below this, and those who were buying considering this as a demand zone, something like this, also got their stop loss hit with this move. So liquidity number two, and the major external liquidity over here, this below zone, sweep of the previous low, right? So the trading style of ours is something like this. Let me show you. There will be a high probability order block over here, unmitigated one with fair value gaps. So this is a bearish structure, so we will only look for sales. So market will come tap this order flow, we will mark the whole order flow, and order block will be somewhere in between the order flow, right? So price will come to our order block, and then we will just catch the high probability move, the high risk to reward move. We will trade this with minimal stop loss just below previous high, and you can see the targets will be previous low just below the previous low. So we trade like that. You have to see things in a different way. So if you need to buy over here, this will be considered as your inducement over here, and then you can look for buys when sweep this low and consider this as inducement, and you can take a small buy, right? So you have to be safe from being the liquidity and trade with the liquidity, avoid traps. Considering this move, this will be your change of character, this will be your change of character, this there will be your high probability order block over here. market will respect your order block just with the wicks or with the body, doesn't matter. This will be your inducement, and then you will enter your trades like this and put your stop loss just above the previous high and target previous low or just below previous low, wait for the sweep, right? So that is how you trade. So market will give you another entry over here. This will be your flip module, right? So market when breaks it, then market comes to retest it. This will be your flip module. This flip module you can just enter here using single candle mitigation, or you can also enter over here when market forms an order block over here, and suppose the market comes like this and hit your order block over here and then gives reaction, right? So let's see some examples in the charts of internal liquidity. As you can see there, this was the previous low which market swept with this move over here, and there was an unmitigated order flow here which market respected and probably gave a reaction to the upside. Let's see. Yes, market respected the order flow. So this was the previous low that got swept, right? So there was liquidity below it that got swept and hit your POI. After that, what did the market do? After that, you can see there this can be considered as a trend line for those who trade the trend line over here. Yes, there was liquidity formed below this which got also swept, and there was also liquidity formed below this, right? It also got swept with this big move, right? So this was the previous high which got swept. As I showed you in the diagram, that previous highs are breaked, and this can also be considered as your inducement. So we sell here, and if this was swept, we also would sell over here, considering that as an inducement. So after that, what did the market do over here? You can see there is liquidity being formed over here as this trend line which formed a stop loss of below this areas. All the buyers were introduced and also the sellers were introduced with this considerable resistance, right? So market gave a breakout, gave them hope, and then there were stop loss of the sellers with this move, right? The stop loss of the sellers got hit and then the stop loss of the buyers got hit, right? And then market moved in the opposite direction as I taught you before, right? So what did the market do? You can see here after market gave this push, there is an order block over here which got respected, right? And then market is sweeping the liquidity above its swing points. Market is in a bullish trend. So what will we look here? We will only look for buys and high probability order blocks. You can see these are equal lows which can be swept by the market. There's liquidity below this and a nice order block which has taken the liquidity. Let's see. There is also liquidity formed over here, the trend line liquidity, sellers, and their stop loss got hit by this move. There is liquidity below this area. Market will come, respect this area, hit the stop loss, and then give reaction. Doesn't matter how much time it takes, but it will respect the zones. It took stop loss from above side because it was in a bullish trend. Let's see what did the market do after that. You can see these are considerably equal lows. Market took the stop loss below here. There were aggressive buyers introduced, right? So market also respected this order block over here. This order block over here, market respected it because this we would be considered as an inducement or liquidity that was below this. This is also the retest of this trend line breakout, right? So there is liquidity, there is volatility included in this move. That's why market gave a good push to the upside. You can see there was this channel kind of formation, liquidity formed, right? There was also this move over here. People were selling this considering as a resistance. Market also gave a reaction. You can see this rejection, and then suddenly it pushed to the upside, hit all the stop losses, right? So you can see this is a major high swing point. This was also being considered as a resistance by the sellers. You can see there were a few rejections. Market also gave a good push. Then those who holded the trade certainly got the stop loss hit by this move over here. So guys, the chart patterns repeat itself. The character of it's repeating in the market. You just have to find the liquidity areas to take the right trades. So guys, I will be dropping a course on smart money concepts and psychological trading soon in a week or two. Join our free Telegram channel. I'll be posting updates over there and trading quiz and all. I will be able to teach you all a lot and help you from being a liquidity and trading with the liquidity being profitable. So see you in the next video. I hope you understood what liquidity is.